So this is an introduction to the basics of tabular statements and what we're going to be doing with tabular statements. And I'm using question one as just an introduction, as an outline. So what I've done is I have a balance sheet here, assets, liabilities, okay, and I'm going to take those assets and liabilities and put them into a document where we put all the assets together, put all the liabilities together. Two things just to look out for here. I have at the top of my balance sheet, I have cost, depreciation, net book value for the fixed assets. So these depreciation figures are all the depreciation written off on all of those assets over the years that I've owned them. So that would be taken from the provision for depreciation account, which is a liability account. So that should really be down with the liabilities. But to make it easier to actually do my calculations, I'm putting it up with the assets, but I'm putting the numbers in as minus numbers. And the second thing that I do when I'm starting off, nearly always in these questions, bank will be a current liability, which means we're overdrawn. We owe money to the bank. So I should really, again, put that down liabilities. But I put it in assets. The reason being that when I receive money, for me, that's a plus. But if I put that in as a liability, it would mean when I receive money, it makes my liability smaller. And I know in the exam, you'll get confused between pluses and minuses. So that's why I say, let's start with bank as a minus in the assets and take it from there. Now, the logic of what it is that we're going to be doing in this question is we're going to be taking, so we have all of our assets and all of our liabilities together, and we're going to make sure, first of all, our balance sheet always has to balance. So we add up everything that we have in the assets column and everything that we have in the liabilities column. And if we've done it correctly, the two of them should add up to be the same. Now I'm just going to quickly add that. So we have the same number of assets and liabilities, so my balance sheet balance is fantastic. So as soon as something happens to change one of the assets or liabilities, you have to have a corresponding change to the liability so that you end up still with our balance sheet balancing. We always have to have the same number of assets and liabilities. So when we if I just kind of suggest a couple of things we might do, we might maybe take some money and use that money to pay off some of my creditors. So my bank here, for example, if I pay 5 grand to my creditors, I'll have minus 5 grand in the bank, and then my creditors will go down by 5 grand. So the net effect of this is I've reduced all of my assets by 5 grand, and I've reduced all of my liabilities by 5 grand. So the change has been the same for both. If I, for example, let's say sold some shares in the business, so let's say I sell 20,000 shares, so I'll have 20,000 more in liabilities because I have 20,000 more shareholders, and my bank will go up by 20,000, so I have 20,000 more money in the bank. So the net effect on the assets and liabilities is the same the whole way across. If I did something like I went and bought a new motor vehicle, I'll have, let's say, a plus in motor vehicles. Let's say I'll buy a motor vehicle for 10 grand. So I have 10 grand more motor vehicles, but I have 10 grand less in cash because I spent 10 grand out of my bank account. So I have 10 grand less. So the net effect there is I have the same amount of assets and the same amount of liabilities. Where it gets a little more possibly confusing is anything that affects an income or an expense would mean that, so that anything that would have gone into the trading profit and loss document would mean that I have more profit or less profit. So if I have incomes or expenses, that will mean my profit and loss balance is going to have to be adjusted. So for example, let's just say I sell goods on credit for, let's say, 5 grand. So I sell goods on credit, so that means my debtors is going to go up by 5 grand. So they owe me 5 grand more. And the corresponding entry, when you're doing your double entry, If I sell goods, you have a debit in debtors and you have a credit in sales. So sales is not an asset or a liability. Sales is an income, which means I have more income, so my profit and loss balance is going to go up by 5 grand. So anything that means that I have more profit or less profit is going to be affected in my profit and loss balance, and brought into this document through that. And the net effect, the net effect there is going to be, we have 5 grand more liabilities because the business owes 5 grand back more to the shareholders, and we have 5 grand more in assets with the debtors owing us more money. That's the basics of how we do tabular statements in theory.